Assalamualaikum warahmatullahi wabarakatuh. Hi guys, let me introduce our group first. My name is Alia Ayu Maharani Wildan. And
my name is Tisa Firkwiulia.
My name is Ratu Kumalasari.
My name is Elida Nur Arini.
My name is Muhammad Aulia Rahman.
And my name is Ahmad Sanuji.
So first I'm gonna explain about the meaning of accounting. Definition of accounting in general. Understanding accounting in general is the process of measuring, translating, or providing certainty about information that will help managers, investors, authorities, and other decision makers to make the allocation of decision resources within companies, organizations, and government agencies. We can summarize the understanding of accounting into the process of identifying, measuring, recording, and reporting financial economic information that is useful for the assessment and decision making for those who need it. The purpose of accounting in general is to provide information about finance, about assets and liabilities of the company to related parties. The preparation of financial statements becomes the most common and most basic accounting task.
The accounting component is divided into five. The first is asset, or commonly called asset, is real resource owned by business entities that can be measured clearly using units of money and the ordering system based on how quickly the changes are converted into units of cash. Assets in accounting are generally grouped into three parts: current asset, fixed asset, and intangible asset. Then the second is the obligation. The obligation is the economic sacrifice that must be done by the company in the future. This sacrifice for the future occurs as a result of business activities. These obligations are distinguished from current debt and long-term debt, where the current debt is an obligation that must be paid in less than 1 year, and long-term debt is an obligation with a repayment period of more than 1 year. The trade capital is a deposit of real economic resources from the owner of the company to the company. Includes in this capital group include income, expense, and price. For the fourth, income is the acquisition of asset or economic resource from other parties as a reward for the delivery of the company's good or service. Consists of operation income and non-business income, interest income. Income in the preparation of financial statement will add to the company's capital. The fifth burden. The burden is a number of sacrifices incurred by the company in order to obtain profits. Expense can be categorized as operation expense and non-operation expense. Operation expense relates directly to the cost of company operations such as salary expense, advertising expense, rental expense, equipment expense, and other. Non-operating expense are expenses that come from outside the company's operation, such as interest expense.
Third step of the accounting. The accounting stage is not only in one process, but accounting activities in which there are various processes ranging from financial transaction to the preparation of financial statement. Well, these repeat activities are called accounting process. The nature of the accounting stage is that it is accountable and its contents must be accounted for. That's because the accounting stage are arranged based on accounting rules. Meanwhile, the understanding of bookkeeping or financial statement is the final result of the accounting stage. The data collection and financial reporting activities are written in certain financial statement formats based on the policies of each company. So, the result of the finance statement are the main benchmark in determining future company decisions and strategies. In the accounting process, it can be divided into 3 stages. Then, what are the stages of the accounting stage? 1. Recording stage. Before you begin the whole process, you definitely need authentic and accountable data. So, the first stage, you must record every financial transaction activity. By recording in detail can facilitate the analysis of cash flow or within the company. After the data is recorded in accordance with the evidence of exciting transaction, for example, from proof of receipt, then the next stage you can classify those expenses. The aim is to make it easier for you to analyze all financial data. Some stages of recording and classifying financial transactions include 1. Preparation or completion of transaction evidence, starting from internal and external company transaction evidence. Then, the recording of each transaction in a particular journal, both general and special journals. The record the result of the recording in the journal and the general ledger report at the end. 2. Summary phase. The next step is to summarize the report that you made earlier. The purpose of this stage is to be able to facilitate us later when analyzing data. The clearer and more concise, the better it will be. In this step, you must go through the following steps. 1. Create or design a trial balance with data derived per balance in the general ledger. Then compose and adjusting journal. The function of this stage is to adjust the actual facts and condition at the end of the period, as well as preparing a worksheet to facilitate the process of preparing financial statement. Next is the closing journal entry. For this stage, the goal is to find out the company profits and loss and surplus estimates and temporary accounts. After that, make a trial balance. After closing, you should check the record again in the next period. Use information from the data to make decisions or policies. For example, to expand the business and investment. Arrange reversing journals in function is to anticipate errors in recording the next period. 3. Financial statement stage. The most recent stage is the preparation of financial statement. At this stage is the result of the second phase of the previous analysis. There are several stages in making an analysis of financial statement. Some stages of the financial statement can be seen as follows. The first stage of balance sheet or is a financial statement that shows its position or of asset, then debt and capital. The financial report contains information about change in company capital. For example, the amount of capital that has been deposited at the beginning. Then the current earnings balance, the amount of additional paid in capital, and also retained earnings balance. Next is the cash flow statement, which are part of the financial statement for a certain period, and the contents are in the form of a typical flow of funds in and out, generally classified according to investment activation cash flow, operating activation, and funding activation. The next step is the financial statement notes, which are additional reports which contain more detailed information not related to a particular account. This giving a more comprehensive value to a company financial statement, so that the profit and loss value will be obtained.
The income statement is a report that presents all revenues and expenses of the company in one accounting period. An income statement is made at the end of a company's period. This report serves to see the company's performance during the one period. The company's income statement consists of components in income statement. First, revenue. Second, cost of goods sold. Third, operating expenses. The component of operating expense consists of sales expenses, general expenses, and administration expenses. Selling expense consists of promotions and advertising, while general and administrative expenses consist of salaries and benefits. Depreciation, building rent, package, and telecommunication service, official travel, parking, security and cleaning, printing, licensing, and professional service, bank administration, insurance, maintenance, and so on. This is the example of the income statement.
Capital change report is one of the financial statements that present information about change in capital in the company as a result of all the main activities of the company's operations in a particular accounting period. This report can be prepared after preparing a worksheet or working paper and income statement, because the source of the report data is related to net income or net loss derived from the income statement. A report on change in capital is needed to be able to explain the actual condition of capital and also know the fund generated during an accounting period. There are several components for preparing a statement of change in equity, namely 1. Initial capital, 2. Additional owner investment, 3. Profit or loss, 4. Price taking, 5. Final capital. This is the example of the capital statement.
The balance sheet is part of the financial report of an entity that was generated in an accounting period that included the financial position of the entity at the end of the period. A balance sheet consists of the three elements, which are assets, liabilities, and equity. In the financial report, there are two groups, asset and passiva. There will be current asset and fixed asset. And within the passiva, there is liabilities and capital. Liabilities spread back into is current liabilities and long-term liabilities. Of the total numbers of activities and passiva, it is also known that the company's reports are balanced. This is the example of balance sheet.
Yeah, that's all from us. Thank you for watching and wassalamualaikum warahmatullahi wabarakatuh.